In this video, we answer the question, what do rising interest rates do to a retiree? Coming up next on Holy Schmidt.
Holy Schmidt!
In this video, we discuss the Fed's recent rate increases and its effect on retirees, and the outlook is, shall we say, less than ideal. Stick around to the end because I will give you my considered opinion on how and when we get back to normal. All right, let's get into it. But before we do, if you've not downloaded my free retirement ready checklist, you can download it at holyschmidt.com/checklist. It is my gift to you. It's absolutely free. As always, I will remind you at the end so that you don't have to stop the video to take this action right now. All right, let's go. Last Wednesday, the Fed raised interest rates by 0.75%. This marks the fifth time this year that the FOMC has raised interest rates. There's a very good likelihood, according to the market data, that they will raise rates 2 more times in 2022 and again 1 time in 2023, probably at the beginning of 2023. In other words, they're not close to being done yet. The dual mandate of the Federal Reserve Board is full employment and price stability. Currently, we're running at a 3.7% unemployment level, so we have full employment, but we're also running at an 8.3% inflation level, so we're very far from price stability. It's important to note that the Fed is not mandated to ensure that the market continues to rise, as you can tell. In fact, the Dow Jones Industrial Average closed down almost 500 points today to a level of 29,590. For reference, the Dow opened 2022 at a level of 36,585, so the Dow is down almost 7,000 points. As mentioned, inflation is running at about 8.3%. Some think that that estimate is quite light. Depending on what you buy and how you buy, that may be a correct assessment. But the important point is that the Fed's target is 2%, so they have a way to go. This means all things being equal, what you're buying today is 8.3% more expensive than it was 12 months ago. It doesn't mean that everything is 8.3% more expensive. Some are drastically more expensive. Think flights, fuel, and cars, for example. Others are actually about the same. On the low end, medical costs have not gone at the same rate as the other categories. In order to know how this affects you personally, you need to know what the Fed is trying to control. Most people know that the Fed raises rates to control inflation, but why? The answer to this, by the way, is the key to everything. First, raising interest rates means that companies who borrow money, and that's most of them, have a higher cost. That higher cost means that the end buyer has a higher cost. So when the Fed raises interest rates, what they're hoping for is that products and services become even more expensive, aside from inflation. And you, the end consumer, think twice about buying that product or service. You say, yes, but Jeff, prices are already out of control and the Fed wants to make things worse? Yes, they do. The reason is that the Fed can't control a lot of the input costs to a product or service, but they can control one. And that is the cost for the company to borrow money or for you to borrow money, quite frankly. They hope that people stop buying and supply gets ahead of demand and prices start to fall. Right now we have the opposite, more demand than supply. It's already turning a little bit. Think about your buying decisions right now. If you're traveling over the holidays, have you noticed that the cost of a plane ticket is far more expensive than it was 12 months ago? Are you thinking twice about going on that vacation? And what about food costs? Are they only 8% higher than they were last year? Hardly. They're a lot more than 8% higher. And gasoline for your car? That is front page news. You may still be willing to get on a plane, take a road trip, or eat at a restaurant, but if prices go up another 10 or 20%, how will you feel? By raising interest rates, the Fed controls prices a lot more than if they allowed the invisible hand of the market to determine when prices go up and down. And anecdotally, interest rates come down, but inflation rarely reverses itself. So this has been a good strategy in the past. The Fed acted late, they admit it, and so inflation got ahead of where it should be. And so now they are very, very aggressive, as we talked about at the beginning of the video. And they do this full well knowing that raising interest rates can hurt the economy, the consumer, and demand in the market for products and services, and frankly, employment. This is why we saw 5 rate increases in 2022, including the 0.75% increase on Wednesday, bringing the total rate increase for the year to 3%. Then there's the other side. Raising interest rates doesn't just affect the cost of the products that you buy, but it also raises your borrowing costs. If you have a drawn credit card, a home equity loan, or you're taking out a new car loan, you'll be paying more today than you were at the beginning of 2022. Mortgages are up over 3% in most cases. If you're a new family trying to buy your first home, this is very challenging. If you're a retiree trying to get a loan for your next home before your current home sells, this is also a challenge. Let's start off with your credit card interest rate. According to creditcards.com, the interest rate on a low interest credit card, meaning someone with a high credit score, went from 12.94% to 15.25% over the course of 2022. This means it's gone up by 2.31%, and that's for someone with a very high credit score. The lower your credit score, the wider the gap. Now that may not sound like a lot because credit cards already start off with a high interest rate, and so the order of magnitude doesn't seem like a big number, but we're talking about 1/5 more in interest costs. And as I said, that's for low interest rate credit cards, and that's for people with very high credit scores. So if you pay for anything with your credit card, you're paying the already inflated price due to inflation and an additional 2.31% at a minimum in most cases. Now, a lot of people, particularly those that watch this video, don't actually have credit card debt, but they will use a credit card in the case of an emergency. But if you're dealing with an emergency and it's a big number and you can't pay it off, you're going to be paying a really big number over the course of the months ahead. Let's take a real example from my life. Let's say you have a dog that may need surgery. This is my dog, Ginger. She's 17 years old. In Ginger's case, the condition is not life-threatening. It's a cyst that seems to be getting bigger over time, but she's also 17, and I may not want to chance anesthesia unless I don't have any other choice. This is particularly true because she's comfortable now. There are no real issues, but it may need to be dealt with in the years ahead. And if she continues to live on in the years ahead, then it's something we should consider, need to consider at some point in the future. When she went in February for her annual checkup, they quoted $2,200 for the cost of the surgery. I brought her in July for an unrelated issue, and they requoted it, and it was $3,000. Fortunately, I have an emergency fund to deal with things like this, but if I didn't, Ginger is part of the family, and I would do whatever it takes to pay for that surgery. So if I needed to put it on a credit card, I would, particularly if I didn't have an emergency fund or something like a home equity loan, which is also a good source for an emergency. But the $2,200 surgery is now $3,000, and the 12.94% interest rate is now 15.25%. Next up is the home equity line of credit. Not a lot of people have these, but they are particularly prevalent among retirees because they are a low-cost source of capital. If you have a HELOC, you'll note that the cost of the HELOC has gone up about 3%. The rate for the average HELOC was between 3 and 4.5% at the beginning of the year. Now it's between 6 and 7.5%. In other words, the interest costs are almost double. Now, what if you need a new car? Well, ignoring the fact that cars today are much more expensive than they were 12 months ago, or the bizarre circumstances that exist where used car prices are almost the same as new car prices, a car loan is up about 3%. So if you're planning on borrowing to buy your next car, you will be paying a lot more. The average price of a new car today is just under $50,000. With 10% down, this means you're financing $45,000, and interest rates have gone from about 3 to 6% for a new car loan. Using the numbers that I just gave you, the payment would be $61, just over $61 more today, or about $3,700 more for the life of the loan than it would have been at the beginning of the year. Finally, let's talk about your investment portfolio. As I mentioned at the beginning, the Dow Jones Industrial Average is down about 7,000 points as of today. A lot of people are confused about this point because companies are charging a lot more today than they were 12 months ago. Doesn't that mean company share prices should go up and the equity market should go up? After all, if I'm American Airlines and I'm charging $7.99 for a flight from New York to Miami and back, and a year ago I was charging $4.99 at the exact same point in time, doesn't that mean that I'm making $300 more profit? Well, as of June 2022, American Airlines had $37 billion in debt outstanding. A big portion of that is bank debt, and bank debt costs go up, interest rates go up when the Fed raises rates, and they come down when the Fed lowers rates. This means that the interest payment on their bank loan would have gone up at least 3% over the last 6-9 months. And that completely ignores things like the cost of jet fuel, which is up 25 to 30% this year and represents about 10 to 12% of the operating cost of an airline. So it's not surprising that the airline is charging more per ticket, yet their share price is going down. Back to your investments. If you have an age-based fund, and most of you do, according to the statistics, this means that the investments that the fund manager is putting your investments in, most of them anyway, are experiencing a very similar phenomenon to American Airlines. Their prices are going up because their input costs are going up, including the cost of staffing, by the way. These companies are also buying more expensive inputs from companies that are also borrowing money. For example, wood is up significantly. If you're a home builder, this is a real problem. And then there's the cost of food. If you are a farmer or a rancher, you borrow money at the beginning of the season and you sell your product at the end of the season. If you borrow money, there's a good chance that that money that you borrowed has gone up in cost along the way. 3 months is a long time if you're a farmer. A few years is a much longer time if you're a rancher. This means that that loan to the farmer or the rancher is going to be outstanding for a period of time and experience the interest rate cycle. But here's how it ends, more than likely. According to many economists, there will be a total of 3 more rate increases, 2 more in 2022 and 1 in 2023. Along the way, companies will be forced to lay people off because people are not buying as much of their product, and unemployment will increase. The unemployment rate will increase. A higher unemployment rate means that people will buy less products still, and prices will start to come down because in order for companies to sell their stuff, they need to lower their price. Unemployment will be a bigger issue than it is today, more than likely, and the Fed will need to reverse the entire process because remember, the dual mandate of the Fed is full employment and price stability. Lower demand will be a big problem for companies that sell discretionary products. Think of things like personal travel or luxury goods or services like lawn maintenance or home cleaning. There are literally hundreds, if not thousands, of these products and services out there, and they're the ones that will be most affected by the reversal. Many economists think that the Fed will wait until late 2024 or early 2025 until they have a clear line of sight on the condition of the market and price stability, and then they'll start to unwind a lot of the interest rate rises that they've put on during this period of time. So the short-term outlook looks challenging, but job number 1 for the Fed is to get prices under control. Given the aggressive behavior of the Fed right now, there is an end in sight, even if it doesn't feel like that to you personally. As a reminder, don't forget to download my free retirement ready checklist at holyschmidt.com/checklist. Also, if you have any additional thoughts on the Fed rate increases, please add them in the comment section below. Also, check out my video on 10 unusual ways retirees cut expenses. This is Jeff Schmidt. Thanks for watching.